Welcome back, everyone. I hope you're doing well. And in this video, we're going to take a look at 6 stocks to keep on your watch list for the upcoming trading week. Earnings season is starting up again, and over the next few days, some of the largest companies on the market are sharing their quarterly report. And we actually have a focus on the financial sector with all of the big banks and the big investment companies sharing their financial numbers from the past 90 days. And this is a recurring series on the channel where every single Sunday, we take a look at the major events occurring over the upcoming week and the companies who may be impacted, just to keep you informed on what stocks you should have your eye on over the next few days. And in this episode, we're going to have a focus on the financial sector, as well as some other big companies who are sharing their latest quarterly reports. And before we jump into stock number 1, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos. And the first stock in this episode is ticker BAC, which is Bank of America. The company currently trades for $40 per share, and from the April lows back in 2020, they have climbed by over 60%. The company currently trades for a $345 billion market cap and with a forward PE of 15.5. And at this current share price, even after the run-up, they're yielding 1.8%. And this company reports their latest earnings. Like we mentioned, all of the big banks are sharing this week on April 15th, pre-market, and we have a revenue estimate of over $21.8 billion and earnings per share to come in at 64 cents. And over the last 90 days, analysts are actually getting more bullish on Bank of America's report and have raised their earnings per share expectations 12 different times. And we can see that over the past 4 quarters, they have one miss, but have seen 3 consecutive beats on EPS guidance and are forecasted to see massive earnings growth throughout 2021. Over 61% year-over-year growth over this latest report, followed by 85%, 29%, and 15% to round out the next 3 quarters. And going forward, although the Fed is not allowing these big banks to actually raise their dividend, these companies are allowed to do major share buybacks, and over the first quarter of 2021, the company bought back $2.9 billion of their common stock, which is absolutely incredible. So although they are paying out the same level of dividends, the company has been buying back more and more shares over the past 90 days, returning capital to their investors in that fashion. And it's important to note that when the pandemic started back in 2020, the financial sector took a major hit and their share prices lost over 40 to 50% of their value in only a few weeks. That's because investors were worried that companies were going to default on their loans and the banks would lose billions and billions of dollars. But if we take a look right now, Bank of America and their CET1 ratio is at an all-time high of 11.9%, which translates into $36 billion above the capital minimum. So these companies and these big banks are in a much stronger financial position now than they were back in 2008, and that's why these companies were able to sustain the problems that they went through throughout 2020 with ease. And the loan losses didn't come in as bad as people were expecting, and that's why we've seen such a rally over the past few months in the financial sector, because these companies are rebounding much faster than people were expecting. And of course, with Bank of America, they do offer their investors that 1.8% dividend yield, which only makes up around 28% of the company's total net income, so a very low and sustainable payout ratio. And going forward, I think Bank of America will sustain their dividend over the longer term. So definitely one of the first big banks to take a look at this week. And now if we continue on into the second stock to have on your watch list, we're going to take a look at Pepsi, ticker PEP, currently trading for $142 per share. And over the past 12 months, the company is up around 6.7%. They have a current market cap of $196 billion and pay out a current yield of 2.87%. And we all know Pepsi, we've all had their products before, and they're a dominant player in the food and beverage industry. And right now, they have $23 billion brands under their Pepsi umbrella, and the company's products are sold in over 200 countries and territories all around the world. They employ close to 300,000 people and have generated more than $70 billion of total sales in 2020. And we can see some of their big names include, of course, Pepsi, Tostitos, Lay's, Cheetos, Doritos, Quakers, and many more. And all of these products are sold in every single grocery store all across North America. And Pepsi, I believe, to be one of the strongest dividend-paying companies on the market that's going to continue to grow for decades to come because the company continues to innovate and offer products in growing categories. For example, the plant-based food industry through major partnerships with Beyond Meat. And if we take a look, they also share their latest earnings this week before market open on April 15th. We have a revenue estimate of over $14.5 billion and earnings per share of $1.12. And over the past 90 days, analysts are actually getting bearish on this report and have brought down their expectation 14 different times. And over the past year, Pepsi has actually beaten EPS guidance over the past 4 quarters and is projected to grow earnings by 4.8% over this quarter, 16% next quarter, followed by some decent growth over throughout 2021. And I'm a big bull on Pepsi, is the 3rd largest holding in my personal portfolio, and I'm actually hoping that the company shares a bad report. I want Pepsi stock to continue to go down in share price so I can buy more of this company at a much more attractive level. And we can see right now the company still continues to perform extremely well, and in 2020, they grew their total revenue to $70.3 billion, which was up over the 2019 high. Pepsi also pays out some great passive income to their shareholders every single quarter, and the company's current yield comes in at 2.87%, and it only makes up 68% of their total net income, and that amount grows at 7.8% per year over the past 5 years. And the company's current dividend growth streak currently sits at 48 consecutive years, which is absolutely incredible and very close to becoming a dividend king. So of course, Pepsi is a name we all know of. I'm really looking forward to their latest quarterly report and will be buying more shares if the company starts to dip after the earnings release. And now on to stock number 3, we're going to take a look at ticker JPM, which of course is JP Morgan Chase, the largest American bank by market cap, which currently sits at $473 billion, and the current share price has climbed to $156, which was up 52% on the 12-month chart. And they trade with a forward PE of only 14.1 and a dividend yield of 2.3%. And this is another company I own in my personal portfolio, and if we see any dip in JPM, I will continue to buy more. I think this is a company that's going to remain operational over the long term and can actually compete against the growing fintech names. They report earnings on April 14th, pre-market. We have a revenue estimate of $30.44 billion and an EPS expectation of $3. And over the past 90 days, we've seen 10 upward revisions in earnings per share guidance. So once again, analysts are actually bullish on this financial company. JPM has beat earnings expectations in 3 of the past 4 quarters, and for this latest report, we're forecasting slight year-over-year growth of around 4%. And similar to Bank of America, although this company is not allowed to raise their annual dividend, they are doing major share buybacks and have announced a $30 billion share buyback plan starting in 2021. So as an investor in JPM, the company's returning $30 billion worth of capital to you in the form of a share buyback. And with their current market cap sitting right around $475 billion, that means the company's buying back around 5% of their total outstanding shares, which is huge for the company's investors. And going forward, I think JPM is still a brand to hold on to in your portfolio. And taking a look at that dividend, the yield sits at 2.3%. They pay out only 33% of their net income, and over the past 5 years, it's growing at over 15% per year. I am a bull on the banks. I bought them during the March lows. I added to my JPM and Bank of America position when they were down huge, and I will continue to hold for the long term in these big companies with rock solid balance sheets, and they reward their investors with some great passive income every single quarter, and they buy back billions of dollars of shares every single month. So that was company number 3. And now if we move on to stock number 4, we're actually going to take a break from the financial sector and jump in to ticker TSM, which is Taiwan Semi. They currently trade for $122 per share, and over the past 12 months, they've absolutely exploded, growing 154%, and a very large company with a market cap of $555 billion. TSM has gone through a slight decline in share price over the past month, and from a high of $140, they have now fallen just over 12%, back down to the $122 price. And we can see right now, the company is reporting their latest earnings on April 15th. We have a revenue estimate of $12.65 billion and earnings per share of 94 cents. And over the past 4 quarters, they have beaten on guidance every single time, and we're expecting some major earnings growth throughout 2021 in the double digits. And for this latest quarter, we're projecting close to 24 to 25% year-over-year growth in their total earnings. And taking a look at the company's income statement, the semiconductor space as a whole has exploded in 2020, and TSM is a market leader in that industry. And we can see from $35 billion of total revenue back in 2019, they've grown it over $12 billion to $47.6 in 2020, which is absolutely incredible. Going from $35 billion to $47 over a 1-year time span is huge for any company, and that's what's really led to the huge rally in TSM's total share price. So I'm really looking forward to this report, and this is a company I actually have just purchased in my own portfolio as well. Over the past month, I did buy the dip and have an average cost on this company right around their current level of $125. And taking a look at the company's dividend, they yield 1.4%. It only makes up around 44% of their total net income. So I think it's very low and sustainable over the longer term. And they grow that payment, averaging 7.5% annual growth each and every year. So if you're looking for exposure to the semiconductor industry, definitely take a look at TSM over this upcoming week when they share their latest earnings. And now on to stock number 5, we're jumping back into the financial sector with Goldman Sachs. Ticker GS, currently trading for $330 per share. This is one of the largest investment banks on Wall Street. The company is up close to 80% on the 12-month chart, and they have a current market cap of $117 billion. And right now, as the S&P continues to climb to record highs, the overall market is trading with a forward PE right around 25, and Goldman currently trades with a forward PE ratio of only 10. So a lot of value coming from this company relative to the overall market. And even after their big run-up, they currently offer investors a 1.5% dividend yield. And the company's done a great job of expanding their operations, and this bank was traditionally only operational for the wealthy, but is now offering products for the mass population, which I think is going to be a great way to expand their total revenue generation over the next decade. People like the Goldman name, they trust it and they associate it with rich people because that's how the company's always been operating. So now if they can give out their services to the middle and lower class, I think it's going to open up more people to the Goldman brand and really expand the company's current operations. And like all of the other big name companies in today's video, they do report earnings this week on April 14th before the market opens, and we have a revenue estimate of over $12.6 billion and earnings per share of $10.19. And over the past 3 months, analysts have only gotten more bullish on this report and have raised their expectations 13 different times. And we can see over the past 4 quarters, they have 1 miss, but then 3 massive beats over the past 3 quarters, and we're expecting 227% year-over-year growth in their EPS number, and I think they will definitely see a very strong report coming from Goldman over the past 90 days. And we can see right now, the company actually performed extremely well in 2020. Taking a look at their income statement, total revenue crossed over $41.4 billion, setting a record high for the company and surpassing the $35 billion set back in 2019. So even throughout a global pandemic, this company performed extremely well, continuing to grow revenue at a very fast rate. And if you buy into Goldman at this current level, they do pay out a 1.5% dividend yield, but it only makes up 15% of the company's total net income, which is extremely low, very sustainable, and they do have a lot of excess capital to buy back their shares. So as an investor in the financial sector, like we saw from JP Morgan and Bank of America, Goldman's another firm that buys back billions of dollars worth of shares to reward capital to their investors in that way as well. And over the past 5 years, that dividend, although it does start at a lower yield, has been growing at a massive close to 14% annually, which is a great sign for Goldman investors. So as a whole, this company has been a staple of the financial industry for 50 plus years, and going forward, I still think Goldman's going to be operational for the long term, continuing to generate more and more revenue every single year, and if the company has a bad report and the shares start to fall, might be a great addition to a nice portfolio. And now we're going to continue on into the sixth and final company in this Sunday's episode, which is BlackRock, ticker BLK, currently trading for $808 per share. And over the past 12 months, the company has grown by 71%, and they currently trade with a market cap of $123 billion and a very nice dividend yield right around 2%. And BlackRock is the largest asset management company in the world. And at this current point in time, they have over $8 trillion of assets under management, which is absolutely incredible. And of course, like all the other names, they do report earnings this week as well on April 15th before the market open. And we have an earnings per share expectation of $7.82 and a revenue expectation of $4.33 billion. And over the past 90 days, some mixed results coming from analysts. 6 bump ups and 6 bump downs over the past 3 months. So looking forward to how this company reports. And we can see over the past year, 4 consecutive quarters of EPS beats, and we're expecting another 18% year-over-year growth rate in the company's earnings per share. So hopefully they can beat this expectation and continue to climb to new record highs. And if we take a look at their income statement, similar to Goldman, total revenue actually saw a major boost throughout 2020, even throughout the global pandemic, when the entire financial sector did take a big hit, and they came in with $16.2 billion of total sales. And if we take a look at their dividend, the yield right around 2%. They're only paying out 45% of their net income, and they've done a terrific job of growing that annual payout by an average of 11% per year over the past 5 years. So definitely another company, if you want some exposure to the financial sector and you believe it's going to continue to climb to new highs, and you don't just want to own a traditional bank like JPM or Bank of America. So in this video, we definitely took a look at some good companies to keep your eye on for the upcoming trading week. We have the major financial institutions like JPM, Bank of America, Goldman, BlackRock, the big consumer brand in Pepsi, and the big semiconductor player from Taiwan Semi. So as for the 6 companies we discussed in today's video, they all report earnings over the next few days, and after the weird Q1 of 2021, I'm really looking forward to seeing how the companies report, if they have strong earnings, weak earnings, and any fluctuations in the share price may lead to some great buying opportunities. So I want to thank you for watching to the end. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So thank you for tuning in. Please hit that like button, subscribe to the channel, and I will see you in tomorrow's video.